What if I told you there's a way to get paid while you sleep, while you have coffee with friends, even while you're on holiday at Sentosa? And what if this wasn't some risky crypto scheme, but a time-tested strategy used by some of Singapore's smartest investors? Stick with me until the end of this video, because I'm going to show you exactly how to build a reliable income stream that can help secure your future. This is crucial information that every Singaporean should have. If you find this helpful, do our community a huge favor. Hit that like button so the YouTube algorithm shows this to more Singaporeans, and subscribe to Wealth for You because we're just getting started. Disclaimer: this content is for educational and informational purposes only. This video does not constitute financial advice, investment recommendation, or an offer or solicitation to buy or sell any securities or financial products. All investments carry risks, including the possible loss of principal. You should consult with a qualified financial advisor and conduct your own due diligence before making any investment decisions. Chapter 1: From Active Income to Automatic Income. Welcome to Wealth for You. So many of us in Singapore follow the same path: work hard, save what we can, and hope it's enough. But what if you could create a system where your money works as hard as you do? Today, I'm revealing how to build what I call your automatic income engine through dividend investing. This isn't about getting rich overnight. This is about building genuine long-term financial security that lasts. Chapter 2: Your Money's Paycheck. The Power of Ownership. Let's start with a powerful idea. What if you could earn a paycheck without having to work an extra hour? That's the core magic of dividends. When you buy a share of a great Singapore company like DBS, OCBC, or UOB, you aren't just buying a ticker code on a screen. You are becoming a part owner of that business. You own a tiny, but very real, piece of that global bank. And when these giants earn billions in profits, what do good businesses do? They share a portion of those earnings with their owners. That share is your dividend. It's not a bonus or a lucky break. It's your rightful share of the profits as a part owner. This is your money, finally going to work for you. But the opportunity gets even more tangible. Think about the shopping malls you visit, or the business parks where your friends work. With REITs like Capital and Integrated Commercial Trust, or CICT, and Ascenda's REIT, you can own a piece of those income-generating properties. Let that sink in for a moment. When someone shops at GEM or Plaza Singapura, owned by CICT, or when a multinational company pays rent at a high-tech biopark, owned by Ascendas, a portion of that revenue can flow directly into your pocket. You are building a portfolio of real, physical assets that generate cash flow 24/7. You don't need millions to buy the entire building. You just need the knowledge to buy a share and become a part owner. This is how you build a foundation of secure, growing income. Chapter 3: The Mindset Shift. From Gambler to Business Owner. This is the moment where successful investors separate themselves from the crowd. Most people treat the stock market like a casino. They chase hot tips and buy stocks based on rumors, essentially gambling with their future. But to build real, lasting wealth, you need to make a fundamental shift. You need to stop thinking like a gambler and start thinking like a business owner. I call this the business owner mindset, and it's your single biggest advantage. Before you ever hit the buy button on any stock, you must be able to confidently answer one critical question. If this were a local shop, would I buy the entire business? Imagine you were investing your life savings into that neighborhood coffee shop. You wouldn't just guess. You'd study their daily traffic, their costs, their competition, and their reputation. You must apply the exact same rigorous logic to stocks. For example, if you're considering DBS, you shouldn't just see a stock price. You should see a global banking business and ask, how do they make money from loans and investments? What happens when interest rates change? If you're looking at Ascendas REIT, you're not just buying a ticker symbol. You're buying a portfolio of properties, so you need to ask, who are their tenants? How long are the rental contracts? Is the occupancy rate high? This shift from being a passive speculator to an active business owner is what separates those who build generational wealth from those who are left wondering where their money went. Chapter 4. The Yield Trap. Don't let greed sink your fortune. This is one of the most critical lessons I can share, so listen closely. It's a trap that has cost new investors millions. I'm talking about the seductive, dangerous allure of the high dividend yield. Many investors see a stock boasting an 8% or even a 10% yield, and their eyes light up. They think they've discovered a secret jackpot. But more often than not, that sky-high number isn't a gift. It's a yield trap. Here's what's really happening behind the scenes. A company's dividend yield is calculated by dividing the dividend it pays by its share price. So a yield can shoot up for two terrifying reasons. First, the company is paying out more money than it can realistically afford, which is unsustainable. Second, the company is in trouble, and its share price has crashed, making the dividend look high. In both cases, that juicy yield is a massive red flag. It's a sign that a dividend cut is likely just around the corner. And when a company cuts its dividend, the share price often collapses with it, delivering a devastating double blow to your capital. Your goal should never be the highest yield. Your goal must be the most sustainable and reliable yield. Think of it this way. A steady, dependable 4 or 5% annual return from a fortress-like company like UOB or OCBC. A return that grows slowly and safely over time is infinitely more valuable to your long-term wealth than a risky 10% yield that could vanish overnight and take a chunk of your initial investment with it. Don't chase the number, chase the quality and safety behind it. Chapter 5. Your Safety Net. Smart diversification made simple. Now you might be thinking, this sounds great, but how can I possibly research dozens of companies without becoming a full-time financial analyst? This is where we deploy the ultimate investor safety net. Diversification. And the easiest way to do it is through ETFs. Think of ETFs not just as baskets, but as your own personal investment fund. When you buy one share of an ETF, you're instantly buying a tiny piece of every single company inside it. It's like ordering a financial rojak. You get a taste of everything in one go, perfectly mixed for you. For us in Singapore, we have some truly fantastic options. The STI ETF is like buying a slice of Singapore's economic backbone. With one transaction, you own a piece of all 3 local banks, Singapore Airlines, Singtel, and other blue-chip giants. It's instant, broad exposure to the heart of our market. The Lion Phillip S REIT ETF is your key to the property market without the hassle of being a landlord. It holds a collection of REITs, meaning you own a diversified portfolio of shopping malls, offices, and industrial parks all at once. For investors looking for a global touch, the Amova REIT ETF provides access to international real estate markets, allowing you to diversify beyond Singapore's shores. Here's the powerful part. This automatic spreading of risk is your best defense against the unexpected. If one company in the STI ETF has a bad year, or one REIT in your ETF faces a challenge, its impact on your overall portfolio is minimal. It might cause a small scratch, but it won't sink the entire ship. Your investment is protected by the strength and stability of all the other companies in the fund. This is how you build a secure, resilient portfolio that lets you sleep soundly at night, knowing you're not betting your future on the performance of just 1 or 2 stocks. Chapter 6. The 4 Hidden Risks. Every dividend investor must know. Now, let's talk about the crucial part many gurus gloss over. Dividend investing is powerful, but it's not a magic bullet. To be a truly smart investor, you must understand and manage these 4 critical risks. Risk number 1. The dividend cut. When the paycheck stops. Imagine your company suddenly announces a 50% cut to its dividend. This isn't just theory. It happened to many REITs and even large companies during the COVID pandemic. A dividend is never a guarantee. It's a decision made by the company's board. If their profits fall or they face a cash crunch, your income can be reduced or even eliminated overnight. That's why you must always check a company's payout ratio and financial health, not just its dividend history. Risk number 2. Interest rate risk. The silent killer for REITs. This is especially critical for Singapore, where REITs are so popular. REITs borrow massive amounts of money to buy properties. When interest rates rise, their loan repayments get more expensive. This directly eats into their profits. And what happens when profits shrink? Their ability to pay you a stable dividend comes under serious pressure. So, when you hear news about interest rates going up, know that your REIT holdings will feel the impact. Risk number 3. Concentration risk. Don't put all your eggs in one basket. This is a classic but devastating mistake. Let's say you only invest in Singapore's 3 big banks because you love their dividends. That seems safe, right? But what if a major economic crisis hits and the entire banking sector plunges? Your entire portfolio and your income would get crushed. You're not diversified. You've made a single, concentrated bet. Risk number 4. Inflation risk. The quiet thief. This is the most stealthy risk of all. Let's say you're earning a nice 4% dividend yield. But if inflation is running at 5%, your real return is actually -1%. You are effectively losing purchasing power every single year, even while your dividend income looks stable. Your money can't buy as much, making your safe investment a slow-motion loss. So, what's the solution? It's a 3-part defense system. First, diversify intelligently. Spread your investments across different sectors: banks, REITs, healthcare, tech, and even different countries. Second, monitor relentlessly. Don't just set and forget. Check your company's financial reports and industry news regularly. Third, prioritize quality. Always choose companies with strong balance sheets and a history of weathering economic storms. A slightly lower yield from a fortress is better than a high yield from a house of cards. Chapter 7. Your action plan. Start small. Win big feeling. A little overloaded with information? Don't be. The most beautiful part of this entire strategy is that you don't need to be an expert or have a fortune to start. You just need to start. The secret is to make your investing automatic. Set up a regular savings plan or RSP with your broker to buy ETFs like the STI ETF or a handful of blue-chip stocks. Whether it's $200 or $500 a month, this consistent action is what builds your automatic income engine, brick by brick. This approach is called dollar-cost averaging, and it's your superpower. It completely removes the stress of trying to time the market. Sometimes you'll buy when prices are low, sometimes when they're high, but over time, it all averages out. This disciplined habit, combined with the incredible power of compounding, is how small, regular investments grow into life-changing wealth. You're not waiting for the perfect moment. You're creating a powerful financial habit. Final thoughts. Your journey to financial freedom starts now. Let's do a quick recap of your 5-step roadmap to secure dividend income. First, adopt the business owner mindset. Know what you own and why. Second, avoid yield traps. Choose sustainable safety over seductively high numbers. Third, diversify smartly. Use ETFs for instant, built-in protection. Fourth, understand the risks. Stay vigilant about dividend cuts and interest rates. Fifth, start small and stay consistent. Let time and compounding do the heavy lifting. Remember, the ultimate goal here isn't just to be paper rich, seeing a big number on a screen that goes up and down with the market. The goal is to become cash flow rich. It's about building a reliable, ever-growing stream of income that hits your bank account regularly, giving you real options, more freedom, and true peace of mind in your daily life. Your journey to that freedom begins with a single, deliberate step. Right now, you have the knowledge and a clear strategy. The only thing left is to take action. If this video added value to your life, please pay it forward. Smash that like button. It truly helps the YouTube algorithm show this to more Singaporeans who need this guidance. Subscribe to Wealth for You. We're building a community of smart investors, and I'd love for you to be part of it. Share this with one friend or family member. Help someone you care about start their own wealth-building journey. I'm genuinely curious. What's the very first stock or ETF you're going to research after this video? Let me know in the comments below. Remember the old saying, the best time to plant a tree was 20 years ago. The second best time is now. Thank you so much for watching and investing this time in your future. I believe in you. Now, go and take that first step towards being truly cash flow rich. I'll see you in the next video.